Today, we are pleased to be joined by Sir Ronald Cohen, who is the chairman of the Global Steering Group for Impact Investment and the Portland Trust. He recently launched his latest book on impact, reshaping capitalism to drive real change. And the conversation will be moderated by Mikkel Larsen, who is the Chief Sustainability Officer at DBS and also the co-chair of DBS Sustainability Council. Without further ado, I would like to now hand over this to Mikkel. Mikkel, please.
Thank you very much. So Ronald, it's such a pleasure to have the ability to moderate a conversation with you. But before we get into it, I suspect that many of the people on this webcast have read your book, and if they haven't, they should. But I think it's worthwhile saying that I think it's great to see that it receives so much praise, but I also think it comes at a time and place where there's a real appetite for these things. And as you and I were just talking about very briefly, I can think of so many reasons why we need it more now than ever. Maybe it's just the need of the hour of the world, but as you mentioned yourself, it's possibly also the time where we have the data and the interest to actually bring about what you're describing in your book. So what I was hoping we might do today, in the interest of myself, but more importantly those listening, is talk a little bit about the what is this thing that we're talking about, the why, the big why around why does the world need it, why do companies need it, and then the how, because I guess there's a lot of people out there that says, well, it sounds right, but can it actually be done? And if I do it the way I think I should be doing, am I purpose washing or am I actually doing the real thing? So if that works for you, then let's just get straight into it. If we start with the what it is, of course, for those of you who read the book, they probably know it by now, but impact capitalism, it's a word, but there's without much substance to it. It can mean many things to many different people. Would it be possible for you in a couple of minutes just to summarize what the essence of impact capitalism or stakeholder capitalism is to you and what it is not?
Absolutely, Mikkel. It's a great pleasure to be here with you and with all the participants in this discussion. I look forward to having an exchange of views with everyone about this very important topic, which is central, in my view, to the recovery from COVID-19, apart from anything else. So we're all aware, Mikkel, I think, certainly all those on this call, that we are digging a deeper and deeper hole for ourselves, environmentally and socially. Despite all the attention that has been heaped on climate change and on social and economic inequality, the problems just seem to be getting bigger and bigger. And the reason is that our system has become self-defeating. It's no longer a question of throwing more money at the approaches we are using. It's a question of changing our system. Why is our system self-defeating? Because companies, in their pursuit of profit, create huge environmental and social damage, which they are very often totally unaware of, and which governments then tax us all in order to try to remedy the ills. Now, that can't work with the scale of industrialization and globalization and so on and so forth. There's no amount of taxation that government can bring that can redress these issues. The problem is that our system is exacerbating inequality and environmental damage. And it isn't a question of talking to governments in order to reduce carbon emissions. It's a question of getting companies to change their behavior. Now, fortunately, we can see a number of trends taking us in the direction of a new paradigm for investment and for business. We've gone from investors and businesses measuring financial return for centuries, thinking about financial returns at any rate. In the last century, we began to measure risk, and we lived with a risk-return paradigm through the Milton Friedman period, with a sole focus on making profits. And the social inequalities have become exacerbated, and we know about the environmental situation. And so my proposition is that we are already shifting to a new paradigm of risk-return impact based on the transparency on impact that technology and big data enables us to achieve. And so the answer to the broad question is we need to bring performance to include impact performance as well as profit performance. We already have more than $30 trillion of ESG and impact investment money, the distinction between the two being that while both share the intention to create impact, impact investment focuses on measuring it as well, where ESG today is unable to do so. It does its best with general reporting. And the proposition that you have a third of professionally managed assets across the whole globe seeking to develop or to generate impact as well as profit through its investment, and that there is no transparency on that impact, is the one that the book addresses.
See, so Ronald, I had a number of questions lined up, and you already threw me off course because now I have 5 new ones I want to answer you. But maybe just for a little while we stay at the kind of the macro level here. And I think if you look at the sentiments that are outlined, you said that there were many things that pointed towards the timing was being right and corporates was ready. We see that like the roundtable in the US has said that they will support stakeholder capitalism. You hear many claims of being companies of purpose, but then you also have those who are skeptical and saying it is about taking the actions, not just about claiming it. In your mind, is this real? Is it about to happen? Or is it just really the companies that are trying to put a new facade on what is, lipstick on a pig? And how do I tell the difference?
So there has been an article written that only 2 companies out of the 180 in the Business Roundtable have actually done anything to walk the walk that they talk about. I don't think, in the absence of dependable impact measurement that investors use in making their decisions, that you can change the behavior of companies. The profit motive is too powerful a force for companies to begin to think about anything else. So we need, in a sense, to incorporate in their performance measures impact. Now, up until then, the roundtable, the people were arguing that capitalism should focus only on making profit. Now you have major business leaders saying that's no longer right. We have to worry about stakeholders. Technological breakthroughs and big data enable us to achieve the transparency now to give the business roundtable the tools to implement what they're talking about, and for everyone, investors, consumers, and their employees, to see how they are performing in walking the walk. The breakthrough I'm referring to is the one covered in my recent Harvard Business Review article, co-authored with George Serafin, whom you know, and you've been involved in this impact-weighted accounts initiative at Harvard Business School, Mikhail, so you know about it. But many of our participants in this conversation may not be aware that for the first time, on the basis of public information, 80% of the necessary information, with only 20% or less being imputed, we have put open source on the Harvard Business School site, impact-weighted accounts, the environmental damage caused by 1,800 companies. And when you look at these numbers, you get goosepimples. Why? You discover a single company creating nearly $200 billion of environmental damage a year. you discover that 15% of all the companies, more than 250 companies, these are major companies across the world, public companies, you discover that 250 of them deliver more environmental damage in dollar terms than they do profit. And you discover that a full third deliver 25% of their profit in environmental damage. Now, we will be adding in the next few months employment impact and product impact to the operational impact that I've just been talking about. And so as of next year, we will have a framework with evidence covering hundreds of companies that you can achieve transparency on impact. Now, what is the implication of this? The implication of this, Michael, is that we are at a historic crossroad now, similar to the one we were at in 1929, in the sense that in 1929, every company could pick its own accounting policies, as you know, and there were no auditors. And after the great crash, investors came to realize that they'd been investing in companies without transparency on profit. And in 1933, the government of the United States led the world, the whole world followed eventually, in prescribing generally or mandating generally accepted accounting principles and the use of auditors. Now, people at the time complained that this was going to spell the end of American capitalism. And we all know on this score that it was a necessary condition to provide this transparency and reliability on our accounting system for us to develop the massive financial markets we've developed since then. Well, we're at a similar historic crossroad. We have 30% or more of professionally managed money seeking to achieve impact with no transparency. Governments must now mandate that starting 3 years from now, every company must publish impact-weighted accounts. And then we will begin to see companies get their impact act together. We will begin to see them reducing their emissions, improving their diversity ahead of the disclosure of their impact, because many of them are going to be appalled by the reaction among consumers, among employees, and among investors that the transparency that is coming is going to create.
So I'm very keen to, first of all, I might score a cheap point here, Sir Ronald, by saying that when Sir Ronald was talking about the accounting system coming into place, for those of you who have not picked up his book, go and do that, and I can refer you to the exact page where Sir Ronald talks about this, is page 116 to 17. So go and read that. It's quite an interesting historical little storytelling around how the financial reporting standards came about. But before we get into the details of the impact-weighted account, I can't help but ask one more follow-up question on the macro level, which is, it sounds to me like you're saying that if these reports, impact-weighted accounts get mandated or something similar, then it will drive the decision-making. Because the question I would have originally asked you, and I'll reframe it a little bit now, is it's all well and good that a new company can be set up with a new legal structure to be a B Corp or be a company of purpose or support stakeholder capitalism. But what about the existing companies that we want to turn around? Is it very realistic that a company that is listed today who thrives on the capital market as they exist today, how are they going to convince their board, and how is the board going to convince their shareholders that they need to put purpose first and therefore maybe accept a lower return? Is that a truism, what I'm saying, or is it not like that?
Well, two points, and please call me Ronnie, Michael. 2 points on that. The first is the ESG money flowing is already having its effect. So in the 1800 company data set at Harvard Business School, you can already see a correlation within certain industrial sectors between higher pollution and lower stock market valuation. Okay, so the most persuasive argument that boards are going to have is this is bad for companies to ignore environmental and social impact, because it reflects itself in underperformance of their share price. Okay, and eventually it'll mean talent leaving them and consumers leaving them. The second point about it is that if you give transparency, you begin to create a race to the top. Let me give you an example of what I mean. So I mentioned in the book, Impact, Reshaping Capitalism to Drive Real Change. The fossil fuel companies, I'm not in favor of investing in fossil fuels, but some of people on the score believe they still have a place in their portfolios. How would they react to the following information? ExxonMobil delivers from its operations alone, without taking into account the use of the oil that it brings out of the earth, $39 billion of environmental damage a year. Shell delivers 13 and BP delivers 8. Now, does that affect your decision where to invest if you want to be in fossil fuels? Now, you'd have to be perverse to think that you should concentrate on ExxonMobil, and in fact, its share price has been doing badly. Why? Because it's obvious, even if you know nothing about impact, that you have a potential risk here of regulation and taxation, and that other competitors of ExxonMobil will do better. And so you shift your money to BP and Shell, and it leads to an increase in the cost of capital of ExxonMobil. And you can take similar numbers in the chemical industry. When you look at a company like Sasol in South Africa, and you realize that on its $12 billion of sales, it delivers $17 billion of environmental damage a year. And you compare it with Solvay, which on similar sales of 12 billion delivers $3.9 billion of damage a year. And you compare it with BASF, which on $77 billion of sales, 5-6 times Solvay and Sasol's, it delivers 7.7 billion, so 10% of sales. You have a range of 10% to 139% of sales in environmental damage. And those huge gaps between leaders and laggards appear in all sectors. So once we have that transparency, which is at the moment on the basis of public information, if governments mandate that companies must release this information and has to be audited, then we will have totally accurate information on which to base our investment decision. But even on the basis of public information, doesn't this transparency create a race to the top? Doesn't Sasol begin to rethink its business model as a result of this? And the same applies in the area of diversity, Mika. So take a company like Intel. Again, this is a result of the Harvard Business School work. If you look at Intel's employment impact, it pays $7 billion in wages and salaries to its US employees a year. And superficially, we would all say, wow, that's fantastic, positive employment impact. But if you measure the demographics around Intel's facilities and compare them with the demographics within Intel, and if you look at the missing people from these different excluded communities and add the wage and salary levels to the numbers, and if you also measure parity of pay and gender parity and so on, and account in a similar way, then it reduces the positive employment impact of Intel by half to $3.5 billion a year. And Intel is one of the leaders in pushing the well-being and diversity of its workforce in tech. Now, if you had every tech company's numbers, wouldn't that create a race to the top, just as it does with profit? So I don't think we can underestimate the power of bringing this transparency. It really will bring impact alongside profit to drive our economic system. Or as I say in impact, it'll bring the invisible heart of markets, which is impact, to guide their invisible hand.
That's very well put, Sir Ron. Allow me to continue to call you that. I don't feel comfortable with the other one. Before we move on, I'm mindful that we could talk forever, but we also want some questions from the audience. So by all means, for those who have questions for Sir Ron, start keying them in so that we can get to them, because otherwise I suspect we will go on for the entire hour. Before we get into this last bit of my questions for you, which is about the operational bit, allow me to just for a minute say why I think impact weighted account has gone where nobody else has gone before. And for those of you who are not already intimately familiar with them, my humble interpretation of them is it's the simplicity of them. So Ron spoke about the fact that 80% of the data you can already get right there. So it eliminates a problem around data that is otherwise would be there. And secondly, the way in a very simplistic form it works is you have your traditional P&L, then you can think of it as having your adjustment column, and then you get to your impact weighted accounts. And so in a sense, it speaks to, for those of us who are accounting trained, it speaks to the accountant in us. It allows us to understand it in a tool set that is already there, not some alien tool set. So for me, that was one of the biggest attractions with it. But what I'm going to do now, Ron, is my chance to challenge you and tell you why it won't work, and you tell me why I'm wrong. And we won't have time for all of them, but the top 5 questions I always hear are the following, and then we'll take them one by one. So Ronald, I'm busy enough trying to do ESG reporting. Don't make me do this on top of it. Why would I need that? There's already KPIs and GRI and SASB. The second thing I always hear is, you can't put a dollar on human life. Don't try, it is silly. I cannot compare environmental damage with creating another job in Bangladesh. The third point I always hear is, it's just too complicated. I have multiplicators effect, I have attribution models, I have up and down value chains. Nobody can explain these numbers when they come out. The fourth one I hear is, the data is not there, and we already addressed that. But the final bit I always hear is, you cannot hold me responsible above and beyond the borders of my own company. I can control what I have legally control over, but don't make me responsible for the supply chain. So I don't know, which one of these 5 are you do you most often hear, and which one of them would you like to tackle head on in the interest of getting impact weighted account being globally accepted?
Well, there are answers to all of them, and let me try and give quick answers. On the question that we have ESG reporting, we don't need more detailed information. I don't hear that very often, I must say.
Okay.
What I hear more is the information we have is inadequate. We are unable to make informed decisions because we can't compare different companies' impact. Some of them are reporting on employment impact, some of them are reporting on environmental impact, some of them are reporting on product impact. It's a salad, and it's very difficult to have a view of a company's proper performance on the impact side. I do hear quite often, is this the right time to heap an additional obligation of companies coming out of COVID? And I just want to reflect a little bit on the situation in 1929, because big crises create the opportunity for big steps forward. In 1929, the notion that you could have a single set of accounting principles for every company in every country across every industry seemed like a craziness to a lot of people, you know. And even when I say that today, you say, wow, how did we manage to do it? Well, it took us 9 decades to perfect, but we have a very detailed financial accounting system. Now, if you think in terms of the cost of that, providing that accounting information, would it have been worthwhile to save the cost of the accounting and continue unable to compare the profit of companies? You know, no. The same is true today. If you consider the cost to the world in taxation to remedy the social and environmental problems that we are causing, This will be an infinitesimal part of it. So that's point number one. The second point you make is you can't measure an improvement in a human life, and you can't value it. It's true that there are some very big judgments that need to be made. But when I started out on this road with the first social impact bond, trying to improve the lives of prisoners who were released from prison, young prisoners, 60% of whom returned to prison within 1 year, that was preventing everyone from finding a solution to it. The breakthrough came in 2010 when two 30-year-olds who were working at Social Finance, a company I was privileged to co-found in the UK, came to me and said, what do you think if we connect a reduction in the number of prisoners to a financial return? And that was the birth of the social impact bond. Now, of course, we didn't measure an improvement in the life in emotional terms or psychological terms. We measured simply the number, and we compared it with before. There are many issues where the comparison is more important than the valuation, and there will be judgments about the valuation, and there are judgments in financial accounting. Financial accounting rules change every month, and they have done forever. On the third one, which is that it is complicated, with technology and big data today, it is simple. As you said, Mikkel, it is not complicated. We will need to define generally accepted impact principles, but you can already read on the Harvard Business School Impact Weighted Accounts website, you can already read the frameworks for measuring operational impact, employment impact, and product impact. So I think the notion that this is impossible is what is holding a lot of us back today from thinking to the world as it is going to be. We have seen myriad accounting approaches, rating systems, partial measurement, partial valuation, and we all despair that this is going to be achievable. But the answer is we've had the breakthrough, just as we've had tech breakthroughs elsewhere in our sectors. And now the best thing that all of us can do if we want to improve the inequality, reduce the inequality in the world by encouraging diversity, fair pay, and gender equality, and so on and so forth. And if we want to reduce climate change, we have to change the behavior of companies. And the only way to change it, in my view, is to get government eventually to mandate it, but immediately for investors to begin to put pressure on companies to disclose these numbers, and through their investments to shift to those who bring in solutions as well as profits, rather than bringing problems.
Very good. One more thing that I also mentioned as a challenge was this, and maybe it's not the one you see, this thing about why am I responsible downstream? And for most people on this call, it's probably obvious, but we've seen cases where companies notionally agree that they have some kind of influence over their supply chain, but when it comes to the actualities of it and there's a lawsuit, of course, things turn out very, very differently. In your mind, what is the best way to get companies to accept the responsibility of supply chain? Because I do believe that without it, we're letting it go too easy.
I think if you have transparency on companies and this information is available and companies are being measured on the basis of their impact performance as well as their profit, it'll be natural for them to pick suppliers that are delivering positive impact rather than negative impact. The whole world will begin to think in terms of net positive impact companies and net negative impact companies. And investors around this call who are thinking, I'm particularly interested in environmental because that's what's crucial in my country, because I'm risking flooding and desertification and God knows what else, you'll pick the companies that are helping to solve these issues. And for those who are concerned about the tensions in our societies across the world that come from rising inequality, economic and social. Your big companies that are helping on on that front. So I think transparency will give us the tool for us to measure the impact of a company and the impact of its suppliers. But if every supplier is transparent, it'll be a lot easier to do than it is today.
Very good. I have one more question, then I think we should see if there's anybody who, I haven't received comments on the chat, so if people want to just ask question, otherwise I do have many more, but the one question that I can't help ask is because I'm sitting here in Singapore, which is in Southeast Asia, of course. Southeast Asia is, many people think of it as the food chamber of the world, right? So it's places where a lot of the commodities are being generated. So these people are at the bottom of the food chain leading up to many companies, multinationals. Do you see, so here's my question, do you actually see this, and you partly alluded to it, as an opportunity for the bottom of the supply chain to actually, because it's so easy, to show their the credentials to buyers upstream? We're seeing a lot of that today. But do you see that this could be the tool for them? Because again, these are an often not large-scale company. So for them, it really has to be super easy. Will impact-weighted account potentially be easy enough to use so that a commodity seller from Asia could use it as well?
I believe so. I believe so. And I believe that the accounting firms, which are very interested in this whole subject anyway, will simplify the process of measuring impact so that it is more appropriate for smaller businesses as well as for the biggest ones. But if you look at companies like Danone, which has been a leader in looking at its impact all the way through its supply chain. The implications for the emerging countries delivering the commodities is huge. Danone has actually, as a result of this thinking, set up funds to improve the livelihood of its farmers, to put carbon back into the soil, to improve fertility rates. You create a different type of ecosystem for decision making, where success is no longer defined as just making the most money. It's defined as making the most money and making the greatest contribution to improving lives on the planet. So it is a next frontier for society and for capitalism, Mikkel. And we haven't thought through or been able yet to predict every implication of this. Just as when we introduced gap accounting, we could not anticipate all of the improvements that would come subsequently. But it is a necessary step now. Let's be clear about this. This is not a luxury. If we don't do this, if we don't bring impact transparency, there is no way that we're going to be able to deal with our climate challenges and with our social challenges. We have to get companies and the investors that back them to achieve improvement on both these major challenge areas.
Very good. I couldn't agree more. So Ron, it's good to see that we're getting questions here, and it turns out that I don't see all the questions. So, and Julia, to make sure that I get to see them, I got one here, and I suspect it's just one of many, and I'm not surprised. So the first question, I'll just read it out to you, sir, is: could increasing access to natural and social capital data feeds lead to novel impact asset classes emerging? If yes, could you state one or two examples? So essentially, could you start to see new asset classes coming out of this?
Absolutely, and what a great question. The first asset class to come out of this is the class of social and development impact bonds, where the return depends on the social improvement. Let me give you a specific example of this. there's a major education issue across the world. We're all aware of that. Hundreds of millions of children, 600 million children are not learning at school or out of school and not learning. We're creating outcomes funds now, $2 billion outcome funds to kick this off, we being the global steering group for impact investment, which operates in 33 countries and which I'm honored to chair. We're creating outcomes funds funded 15% by the local government, the rest by official aid organizations and big philanthropists, to sign contracts with delivery organizations according to a rate card. We will pay you so much. The first two programs are in Ghana and Sierra Leone, so let me use those examples. For a young man from a city that completes his primary and secondary school education, we will pay more. For a young girl that does, we'll pay even more. If they come from a village, we'll pay even more if they're disabled. Armed with these contracts, the delivery organizations, which can be charitable NGOs or can be businesses, purpose-driven businesses, go to raise funds from development impact funds, forgive me. There's one being set up by UBS and Bridges Ventures. Bridges is another fund manager that focuses on impact, which I'm privileged to have co-founded. And those funds will fund the organizations delivering the educational improvement in the same way that the venture capital funded tech entrepreneurs. So impact investment is funding social entrepreneurs. Now, what's the interest for investors? The interest for investors is by investing in these UBS funds, in this particular case, they're taking the delivery risk only. They're taking the risk of this NGO or this business being able to achieve the educational improvement targets in the contract. In return, they get their capital back with a return that increases with the success of the intervention. Now, if you look at the first couple of social impact bond funds, as they're called in developed countries, so in this particular case in the UK, the gross return on the first Bridges fund has been around 8%, so say about 6% net. 6% net uncorrelated return is something every one of us on this score with a diversified portfolio would want to invest in as much as possible. It's an absolute return category. So it is a new asset class that delivers uncorrelated returns while solving social issues. Now, there are already 15 social issues in 30 countries that have been dealt with through 200 or so social and development impact bonds. So that is one example of it. Another example of it is these performance-related green bonds that are being issued now, where if a company raises money for a specific environmental purpose and achieves its targets, you begin to see a decline in its interest rate. It's not exactly a different asset class. Obviously, it's still in the nature of a bond, a variable yield bond, but it could well be that these bonds find themselves less correlated than a bond that depends solely on interest rates. Here, there will be an element of performance which may uncorrelate them a bit from the rest of the bond market. So those are just two examples of how bringing impact measures and pay for success can begin to create new asset classes.
That's such a fantastic answer, also because for those of you who haven't had a chance to look into social bonds or pay for performance bond, there really is some innovative things going on. We as a financial institution is something that we've been looking at as well. And whether you want to find yourself into nature-based solution or trying to solve social issues, these really are the things that create the real impact. So whoever asked this question, I think it's a good one. Of course, there's some discomfort in the fact that there is, although it's uncorrelated return, you're taking a new types of risk. But I totally agree with you, Sir Ronald, then that this is a type of investment we need more of. It does lead me to perhaps follow up with one question, if I may, of my own, which perhaps also is also what the asker was thinking about, which is we see that today there is an investment class around carbon credits. It's a tradable product these days. Could you imagine a future where other type of, and today when you buy carbon credits, and let's forget about some of the problems with the product itself and about the accuracy of it and some of the other problems, but we all want to resolve issues of climate change. It comes naturally with nature-based solutions with ancillary benefits on biodiversity and job generation. Could you imagine a future where when you have this data available, that you could create whole new asset classes around biodiversity or job generations or many of the other things that exist in the safe and just operating space simply as a class in itself? Or do you think that's a step too far?
No, I think, Mikkel, you're right on the button in asking the question, and I was discussing it in the environmental context with Bill Winters, the head of the Chartered Bank, just yesterday. When we get impact transparency, it's going to expose companies' impact performance, and if they want to improve their performance, it's going to take them some time to do so. Yeah. So a way of offsetting their negative impact through a market where they can buy credits is a very important step. We need to create these markets. Now, these markets haven't been very accurate, as you've been saying, in pricing the environmental damage that is being created. But nevertheless, they are a market, and they are a way to begin to improve impact. Now, I haven't heard the idea before of being able to do the same thing in the labor market, for instance. It's perfectly plausible that this might become a market too, that you might have a diversity credit. If you have insufficient diversity, that you buy credits that are used to fund greater diversity elsewhere. Certainly something to think about.
Yeah, because we could probably go on for a long time. I happen to be on the same alliance that the Winters are on, or he's leading. So I know a bit about it as well. And we're doing some of our own stuff. But I think when I first came to this, it felt an awful lot like buying forgiveness. But we have to remember that markets do one thing really well, which is it finds mechanism for you to invest in bit-sized tokens. So rather than you putting all your money into creating jobs in a place where you might have a supply chain, you can now do this in an easier, accessible way. So I also think this has a future. But anyway, it's not about what I think, Sir Ron, it's about what you think. I did have one more good questions, and it's not a surprising one, so allow me to read it out to you. It states, what countries do you believe will be the first movers in mandatory impact reporting? And what are some of the conditions that cause them to be first movers, which others can reference to? It was a very obvious question to get, of course.
A great question. So in 1933, the US moved first on generally accepted accounting principles. Today, depending on the result of the election, it looks unlikely that the US would move first. More likely are countries in Europe and perhaps in Asia, countries like Singapore in Asia. Within Europe, I would say that the Netherlands, Scandinavia, Britain, France, would be the leading possibilities. And a combination of these may sway the EU to add to its excellent push for more extensive reporting on climate change, this transparency on total impact. As I said a bit earlier, Mikhail, big crises tend to lead to bold action because people expect it. What is going to be the New Deal coming out of COVID-19, given the inequalities that were brought into relief after the 2008 crash and that have existed for a quarter of a century in an exacerbated form, as a big chunk of the population has seen stagnation of real income, and a tiny proportion at the top has seen astronomical growth of remuneration. The New Deal has to be to bring a fairer society and a more sustainable world. In my view, the only way to achieve that is by bringing companies and investors to play that role, which is already being played, but without the tools they need to play it effectively. 30% of professionally managed assets going to ESG and $1 trillion this year of impact investment where the impact is measured is beyond tipping point, Mika. This is already happening. And I think at times like these, when we see that transparency is viewed by consumers, by employees, by investors as a human right, we have the opportunity for some governments to take this bold step forward.
That's a wonderful vision. And we are running out of time, so we just have a time for it. Does somebody have one more burning question? There was one follow-up here, which you would be perfectly placed to answer. Let me try and paraphrase it. So Ronald, why do we need this now? We need to focus on getting climate change done. We have a way to measure carbon. Now you're introducing social and you're just making things more complicated. I think nobody would be, it's paraphrased in my words, but nobody's better placed than that, given your background of having actually started in the social space of measuring it. So why can't we just get climate change done and then we'll deal with the other one later?
A great question. And we should push with climate change. And we have come out with environmental data first on the Harvard Business School site because there's 4 decades worth of analysis and science to measure and to value environmental impact. The difficulty with doing just environmental is if you want to change the behavior of companies, you need to have transparency on their total impact so that they can't say, yeah, we're doing very badly on environmental, but think of the great impact we're delivering on employment and on product. You're crazy to want to put this out of existence. We are net impact providers overall. And given that the technology is the same to measure impact, product, and employment, environmental product, employment, and operational impact on people and planet, my view is we should put the pedal to the metal and try to achieve transparency on all the impacts of companies. Because what we want to do is to change our system so that we solve the climate change issue as well as the social issues. Now, there are 2 schools of thought. There's one school of thought which is, let's just do it gradually and let's start with this first milestone of environmental. And there's a second one that says, when there are great crises, there are great steps forward. I happen to subscribe to the second one, but it doesn't prevent me from putting all my weight behind achieving what is currently being achieved in bringing changes in reporting on the environment. But reporting will not change the behavior of companies. That's the fundamental reason why we need to go for accounting. And if you go for accounting, are you going to go for just environmental accounting? why would you do that if you have the availability now to deliver the whole package?
Okay. So that was very, thank you for that answer. And again, sharing my own personal observation, that was exactly why we went and were trying to do impact measurement, because it's way too easy to get stuck in a conversation. Every product that you deliver creates some social goods and some environmental damage, or many of them. But how do you figure out the sizes of these things? That's all that makes a difference. So Ron, much to my regret, we are running out of time. So I'm going to ask one last question here, which I will hopefully do on behalf of everybody. After having listened to you for an hour, I suspect that if people didn't come into this call as a believer, hopefully by now they are. So now I'm a believer. What is the one thing I can do if I work at a company today to go and try and make this your vision come about? What is the one best thing I can do?
Well, the immediate thing you can do is to make sure that your portfolios, if we're talking of investors, make sure that your portfolios are ESG with an allocation to impact investment, perhaps an allocation of 10% to impact investment where there is measurement of the impact. We see ETFs in the ESG area. You know, the FTSE for good, of which you're a part, is another example. So there are plenty of products around ESG. Within impact investment, we see all the major private equity groups, many venture capital groups, many specialist alternative asset providers delivering combination of impact and market rates of return. And I think what we haven't touched on today is you will outperform financially by optimizing risk return and impact rather than optimizing for just risk return, because you will alter the risks that you're taking in a favorable way, and you will open the door to new sets of investment opportunities, Tesla being an example of an impact company that seeks to deliver great increases in value. The second thing, though, that you can do as an investor now is to push for this transparency. If you can go to the GSG, the Global Steering Group for Impact Investments website, and sign the Leaders Declaration, it's been signed by more than 500 people. You'll see the first 60 or so prominent names at a glance, if you want to look at a shorter list. If you could sign that, let's push for an impact-led recovery that brings us transparency so that companies begin to contribute to the recovery from COVID. And let us tweak the regulations around trustees of pension funds and charitable endowments, so that they go not from these trustees having the ability to look at other considerations such as environmental and social ones when making financial decisions, but the obligation to do so.
Wonderful. I couldn't think of a better way to finish this. Regrettably, our time is up, so Ronald, I will say, on behalf of everybody here, I'll say thank you, but also say that for your sake, for my sake, but for the sake of everybody, the world and our children here, let's hope that your vision comes true. Let's hope it becomes our vision. Thank you very much for your time, and I'll hand it over to Angelia again.
Pleasure, Mikhail. Thank you very much.